The administration has been focused on housing affordability, but will prices actually go higher in 2026? This is a great question and a lot to dig in today. It could get actually a lot worse, and let's talk about why that might be. So, number one, you have to understand that the 30-year mortgage payment has just skyrocketed. You can see here since 2000 that the 30-year mortgage payment has gone all the way from about $1,200 to $1,500. And then in 2022, when the Fed started raising rates, it just popped all the way up to $3,000. And then it came down a little bit as rates have started to come down. But it's become so unaffordable for the next generation to purchase houses that prices will come down in 2026 across the board. We will show you all the forecasts from all the major players and why it's likely not going to be a positive year for housing this year. Ultimately, we can again see from 2022, we had monthly payments jump from $1,600 to $2,600 per month. And you have to be real with yourself. We live in a payment economy. The consumer is completely maxed out with credit card loans, student loans, with car loans, all these different loans that they have available. And having a payment increase 62% within just 2 to 3 years is a drastic change on shelter cost that is preventing the next generation from being able to purchase. And that is why prices will continue to come down across the United States. Of course, real estate is micro and every area is going to react differently. But the truth is that the locals on the ground in a lot of markets are priced out, and we need prices very badly to come down moving forward. So the question I want to ask you right now, looking at this chart, ask yourself, is now a good time to buy? And comment below. Let us know. Do you think, looking at this chart, just be realistic, this is inflation adjusted home prices, US home price history from 1890 to 2026. And you can see the market is volatile. We have ups and downs across the nation in terms of home prices. We can see here that we had the 2008 bubble, 2006 is just skyrocketing prices. And then we had the correction. Obviously, the '08 to 2012. It took a couple of years for the prices to actually come down. Real estate's in a liquid asset. It takes time for the prices to adjust. And then we had the 2026 bubble. That's right now. You can see we're way past the 2008 period in terms of our prices, and it's going to come back down. This is called mean reversion. The payments are too high, and your ability to rent another house for much less than you could purchase a house just shows you that people would rather rent. We have an oversupply of rentals here in the Sun Belt because of the overbuilding from new construction for single family homes and for multifamily homes, which is great for buyers. So buyers, you have taken the back seat for the last 3 to 4 years, and now you're going to be taking the front seat, and you're going to be in total control in your negotiations with the majority of homes that hit the market. We're seeing homes, if your house is not perfect, and reach out. If you need a top agent in your marketplace, reach out. Your house has to be perfect. It has to be priced right, below all the other comps in the neighborhood. The condition has to be phenomenal, has to have the upgrades. And if it does not have those key aspects, price right, and it's upgraded and the marketing is fantastic, it often does not sell. And they're starting to sit across the board, even with the rates coming down recently with the announcement from the Trump administration saying we're going to buy $200 billion of mortgage-backed securities. Well, today we're starting to see the rates go right back up because the bond market is massive, and $200 billion is not going to make that big of a dent. Maybe they bring down interest rates a quarter of a point, 0.25 basis points and or 25 basis points, and that's about it. Now, right now, because the prices are so high, we're seeing pending home sales drop super quickly. You can see since 2022, we've just seen this drop off. We have a little couple bounces here and there, and then it drops right back down. This is because it's just taking time for sellers to adjust their expectations on the price that they can get, right? Sellers want that 2021, late 2021 pricing, and buyers, they want 2019 pricing before we had this massive run up. And here in Florida, we had a 68% run up in home prices within 5 years. That's obviously sustainable, and we're clearly in the bubble period, as you can see from the prior chart. Again, ask yourself, if you were a buyer today, would you buy if you did not already own? We are working in a payment economy. Now, all of this pricing has flipped the narrative completely, where new home inventory is skyrocketing, right? So builders thought that this would last forever, these low interest rates, the massive amount of migration, and they just built a ton of inventory, and now they have completed inventory at a very high level. They have under construction, tons of inventory under construction that's coming on to the market, and then a bunch of product that's not started. Well, we're at 2009 levels for this new home inventory currently. And this is an indicator that now new homes are actually less expensive than existing homes because in a lot of areas, they've completely overbuilt the market. That includes here in the Sun Belt, here in Jacksonville, Florida, where we see almost every street has new construction on it, multifamily or single family, because these builders thought that the migration patterns would continue forever. And that's just not the case. They've actually come down to net zero right now, according to a recent Bank of America study. Here in Florida, people are not relocating as much as they once were because the affordability factor is no longer there here in Florida. Now, new construction, this is a great chart that shows that new home prices have dropped by 27% for Lennar. This is net of incentives. So not only are they dropping the price, but they're also saying, hey, we'll pay for your closing costs, we'll pay for upgrades, we'll do whatever we can to sell our inventory to you. A lot of them are building entire communities and they're selling them to build to rent owners and operators. So that way they just rent out the entire community and that's their backdrop for it. We're seeing this locally. There's a lot of reports about these communities that were having a really hard time selling and they just sold them to these institutional investors that can wrap a big mortgage around it at an economies of scale price versus a one of one price, which is huge. But new construction is now lower than existing home prices. Then typically new homes are about 20% higher than existing homes. They also rent for more. So that is why these build to rent operators are looking at this new construction. Well, they're going to rent for more, they're newer, so they need less maintenance, things like that. There's a lot of reasons why this kind of inversion of the existing home prices and the new prices are a massive indicator to the market of what we are looking to see and experience next. So if you have an existing home, you're going to be competing against new construction for those next wave of buyers that come into your marketplace. And here's the reality of the next wave of buyers. This is a problem. Empty nesters own 28% of large homes, while millennials with kids only own 14%. So we have this massive number of people who own these large houses that don't have any kids there anymore, and they need to sell these houses or they're going to live in them for the rest of their life. I don't know what they're going to do with these large houses, but most people, they end up downsizing. But the question is, who is the next buyer at this point in the market cycle for these large homes from these empty nesters that are trying to exit and downsize? Now, when they try to downsize, they're trying to pull their equity out. They have to pay closing costs. They have to pay their capital gains on it. They have to see what they have left over to be able to pay for their next house. And if they have to get a mortgage on their next house above 6%, that becomes a massive issue. And if they're not working, are they going to be able to qualify for a mortgage for the next house? These are questions that a lot of people are wondering. That's creating this kind of freeze effect in the marketplace where people aren't able to transition as much as they would want. So again, I don't know who this next buyer is, who's buying at today's prices, who can afford these massive payments, because the amount of money that you need to make just to pay after tax to pay your mortgage at today's median price and median rate. I mean, we did the math. It was like you need to make $41,000 to afford a normal house today. And that's a lot of money. In Jacksonville, our median household income is 68,000. So you're talking more than 50% of somebody's income would just go to shelter costs to be able to buy a house today. And that's why you see a lot of people just choosing, you know what, I'm not buying a house anymore. We need prices to come down. We need rates to come down. I'm just going to go ahead and rent or move in with other people. We see this happen across the share of first-time home buyers, which is also declining. You can see in 2010, it was at 50%. And today we're all the way down to the 20s. I mean, the low 20s. So first-time home buyers, they don't have the money. The price is way too high. They don't have the money for down payments. They're loaded up with debt. And this is a huge red flag. Anytime there's not more first-time home buyers coming into the market, you've all seen those charts go around that says the median age of a home buyer is now 59 years old. These are red flags showing us that the market has changed drastically and we're in for a correction here in the market. A correction is 10%, a crash is 30%. My base models show that we should be seeing prices come down 31 to 42% from the peak in October 2022, and that we don't know what time frame that's going to be. The government is stepping in, trying to prevent this basically from happening, all these declines from happening by manipulating interest rates, coming up with different products. We will see what actually happens, but this is what is happening right now. The share of first-time home buyers is declining, and that is a massive red flag for an unhealthy housing market. Further, delinquencies are jumping. We're starting to see people get their wages garnished in a couple weeks. I know that just got delayed. There's news out today about that, but their wages being garnished from the student loans. The auto loans are spiking across the board. The credit card loans, you hear those stories every single day. And people have stopped tapping their equity in their house. We've seen that too. They've really slowed down the amount of money they're pulling out of their house to pay for things, which will slow the velocity of the economy because a lot of people use their house as an ATM basically. But you can see across the board that delinquencies are moving up. On mortgages and FHA, we're already seeing near 12% delinquency on FHA, and we see every single month FHA loans continue to become more and more delinquent. All of these delinquencies are starting to stack up in the market, and it's just a matter of time until the market cracks. Now, here's what I want to talk to you about at the beginning is home price forecasts nationally. It's a wide range. You can see Cotality. They're expecting a very bullish outlook along with NAR, which no surprise there. NAR is always bullish, 4.5% to 4% growth. This is nationally. Obviously, there's going to be different regions that perform. And then you see the National Association of Home Builders. They're negative because they know they're closest to the data. They're having to cut all the time on their pricing. So they're negative on what's going on. And a surprise here, Housing Wire, who just said we are going to have the largest bull run in the next 50 years. But then they're also saying here that, next year we'll actually see home prices go down 0.6%. So I don't know. Their data is all over the place. I guess it just depends on perhaps who just pays them for that day for the media that they put out there. So always ask yourself when you see these sources, who is the person paying for? It's just like the National Association of Realtors. They have to come out every single year and say that the market's great. Of course they do. They represent real estate agents. That's what they do. They say that to sell you information. So you try to find the most reasonable person out there that probably has the least amount of skin in the game, who's the most objective point of view. Zillow does have skin in the game, but they've been pretty honest with their forecasts. They move pretty quickly down. They move pretty high up. Same with Redfin. So I definitely think that this middle of the pack is likely where we'll end up. However, we're going to see regional differences in the South. Obviously the Sun Belt areas that are overbuilt, we're going to see prices decline, but this is just nationally. I do think we're going to end up around 1%, which generally you see 3 to 4% price appreciation every single year. So this is an indicator that things are changing directions across the board and people's forecasts aren't as strong as they have been in prior times. Now, in regards to why prices will start falling, this is the ultimate chart that you need to look at. It's cheaper to rent than to buy. Why would you go out and buy a house, have to deal with the maintenance, and you would have to pay with the HOA, your taxes, your insurance, have the risk, and you would have to pay $2,700 when you could rent that same house for $2,000 or less and collect that extra $1,000. I mean, I don't know about you, but $1,000 a month for first-time home buyers saved is a tremendous amount of money, and you don't have any of the headaches because you just call the landlord to fix something. So this is really, really important. This gap right here, and you see this gap did not occur previously. It used to be cheaper to buy, right? In some instances than it was to rent. But now it's just become so different. And now we're overbuilt. You can negotiate months off of your rental agreement. You say, hey, I want 3 free months rent. I'll sign a 15-month lease. You have the power now to be able to negotiate. And this is why the housing market is frozen. This gap basically shows the same thing from my calculations, is that prices need to come down 30 to 40% to catch this gap and make it make sense again to purchase a home at today's market rates. And here's the other problem. Rents are already coming down. Look at this. Austin, Texas, down 21%. Fort Myers, down 18%. Colorado Springs, down 15%. Phoenix, Arizona, 13.5%. Across the board, Raleigh, North Carolina, down 12.5%. People don't understand, when rents come down, it throws off the entire dynamics of this chart when people go do the math. Hey, should I rent or should I continue to buy? And it's one of the most important things. The rent coming down makes investing really difficult. It makes it really difficult for people to choose to buy. And this change could absolutely crush the housing market over the next couple of years as rents continue to move down. I'm in Jacksonville, Florida. It shows that we're down 9.7% from the August 2022 time period. We're down in some areas more than 20% on rents already, okay? And so the decline is just beginning here locally here in Florida. And another interesting stat I want to put out there, because it's not all bad news. This is pretty interesting. Some people are starting to give up their low rates and just pay the price to sell their house and get a new house at a higher rate. We can see this. The blue line are the sub 3% mortgages. You're starting to see this decline. It's only about 4% of people, and then you're seeing an incline of the 6% plus rate. So people are starting to capitulate. They're saying, you know what? I'm going to give up my low rate. I'm going to go ahead and move and pay the higher rate, and maybe I'll use some of my equity so I have a lower mortgage that makes up the difference, and they lock their equity into that house. This happens across the board. This is a positive sign for housing, but it's not enough. Look at this, just from 24.6% to 20.2% here. And here's the truth. As we go into midterms in November, the government, just like any person who's in office, they don't want the housing market to slow. A bad economy is the number one thing that's going to kill somebody's reelection or somebody who's trying to get votes. Okay, so whichever side you're on, it doesn't matter to me. Both sides play the game. Both sides want interest rates to be zero forever and to drive the economy higher and higher. And the reason why this is so important right now is because there's so much equity in houses because of this major run up in such a short period of time. Well, home equity accounts for the majority of net worth for Americans. All Americans are about 66% of their home equity is their total net worth. Look at this from the specific ages. Obviously under 35, a lot of folks don't even own houses anymore in that age demographic. 35 to 44, 45, you can see it starts to move up. But when you do the average of all Americans, it shows to be 66% of their net worth is home equity. So if you see their net worth start to slowly evaporate over the next couple of months going into this year, going into midterms, it's going to impact you politically. So of course, the government's going to do anything that it can to prop up this market, right? So here's a picture of Trump. He's throwing spaghetti at the wall. He's saying, let's do assumable mortgages. Let's do portable mortgages. Let's do 50-year mortgages. Let's buy $200 billion of mortgage-backed security, which is basically quantitative easing, but not on the Fed's balance sheet, but on Fannie and Freddie's balance sheet. It's just a different version of it. Let's pump up this market and see how long we can last and get at least past these midterms. That's what they're trying to do. Well, the problem is this doesn't actually solve the affordability crisis. If you're going to lower rates, it just keeps prices higher and it all narrows out. And if you continue to see rents move down, that's a huge problem as well, because now you're competing against rents versus the payment, because that's the ultimate thing. What is the opportunity cost? It's rent versus payment. I don't think this is a good move. I think it's just more manipulation. You're basically trying to manipulate the market to get out of prior manipulated markets. So the government is really incentivized to keep things going for as long as possible, especially up to the midterms. That's why I am negative on the housing market. Absolutely. I don't know how much intervention we'll be able to play to counteract the decline in prices. It'll be really interesting to watch this year. I think this is going to be a really critical year for the housing market. We've already seen a slight bump in activity from buyers coming off of the sidelines with the rates falling for the last 2 days, but then the rates came right back up and it started to slow again. Because we track this stuff. We have all these Zillow leads, we have Google leads, we have all these leads that come in from all these sources, and our agents are constantly reporting us. We have some of the best agents in the country working at our firm. We have friends around the country that report into us all the time about what's happening in their market. And again, if you need a real estate agent in your area, reach out to me. I'm happy to put you in touch with a top agent in your market. There's a stat that just came out that showed that 71.1% of real estate agents did not sell a house last year. So again, if you need to get access to a top agent, let me know. I know the folks who are definitely top 2% out there in the marketplace. You don't want to get stuck with a really bad agent, because it can completely change your outcome from negotiating tens of thousands of dollars, sometimes hundreds of thousands of dollars, when you get stuck with some of these really bad agents out there. And it's really hard as a consumer to tell who is good and who is bad. But the market for the majority of agents right now is bad because sales velocity, you saw those pending sales velocity has slowed down. I actually expect this year sales velocity will speed up. The reason being that I think sellers are going to start capitulating on price. I think the government's going to do whatever they can to manipulate interest rates lower. And I think those two factors will bring back those marginal buyers into the market. I still think it's a really hard time to buy. You need to negotiate like crazy to protect yourself from the downside, because I think just on that historical chart, just look at that chart again that I showed you at the beginning of this. Is now a good time to buy? Ask yourself that. Go look up a chart for your local market and see what the prices have done. And just look at the chart and say, is now a good time to buy? I think it's a good question to ask yourself before you make that huge commitment, because buying real estate is expensive. It can cost round trip 10% of the investment in and out. On the buy side, you pay in. On the sell, you also pay commissions and fees and things like that. So my question to you today is, will the government be able to hold off price declines in housing before the midterms in November? Do you think that they can hold off these declines that are coming? Where are you located and what are you seeing on the ground? I love hearing from you folks in the Northeast. So many people say, we're not seeing it here. We still have low inventory. We don't have the overbuilding. Let us know if that's the case for you. But I also hear from people in the Northeast who are saying, yeah, things are really slowing. We don't know who the next wave of buyers are for this market because the payments make no sense. So I'd love to hear from you on what you're seeing, because here in the Sun Belt, almost everybody is now saying what I'm saying here. We're overbuilt. We have a lot of inventory. Prices are coming down. Rents are coming down. Houses are sitting for longer. Sellers are having to slash their price, et cetera, et cetera. So let me know. As always, you can follow me on Substack. I'm also on X and have somehow gone viral on there several times. So if you want to follow me, it's at John Brooks on X. Follow my Substack for a deep dive into what's going on in real estate. And I talk about things there I can't talk about here on YouTube. So thanks so much for following as always, and I'll see you next week.